So falling rates, cumulative returns since 1981, just to give you an idea of how strong returns have been in the bond market because interest rates have fallen and the prices have gone up. So we ran long treasuries for that time period, and this is through the beginning of, or through the end of 2013. On average, long treasuries on an annualized basis returned over 10% versus an S&P 500, which returned just shy of 11%, but approximately the same returns. This cannot happen again. I'm not so sure about the stock market, but certainly to get 10% returns is impossible. Interest rates would have to fall negative and continue to move negative, and that's not going to happen. So a lot of people's asset allocation plans look at history, and they're looking at bonds, and they're looking, saying, hey, I'm going back 30 years, but not necessarily a realistic time period to look at if you're trying to extrapolate forward what you expect bond returns to be. Something's not right with this picture. Treasuries and treasury yields and the S&P 500 tend to sort of move in the same direction. And it makes sense that as the economy slows, say in 06 through 08, interest rates are falling. At the same time, the stock market's falling. And then as the economy recovered in 2009 forward, the stock market's really taken off, but interest rates have continued to fall. A rare occurrence. The Federal Reserve is certainly doing this on purpose to continue to add stimulus to this economy as much as they can. But this division here has to bother them somewhat. So one thing has to change. Either equity prices have to fall to justify where yields are, or yields need to start rising and probably fairly quickly when they do start to rise. Something's also not right with this picture.